In this video, I'm going to show you how to get the best credit score. This will be a complete guide to improve your credit, so make sure to watch the entire video. Hello everyone, welcome to Financial Business Network. I've been a financial advisor and business analyst with some of the largest banks in North America. I'm going to show you how to fix your credit score and give you the best possible credit score. The purpose for this channel is to provide financial information to help you improve your financial situation. I'm going to be making several videos on topics that will help you grow your net worth and put you on the path for financial success. I will also focus on other topics like health, motivation, and important topics that will help you improve on many areas of your life. If you are new to this channel, hit the subscribe button and the notification bell so you don't miss a video. Okay, so let's begin. So what is a credit score? So a credit score is a three-digit number between 300 and 850, and it represents your credit ranking in terms of how good of a borrower you are. Higher numbers mean you are better at borrowing, and lower numbers mean you are worse at borrowing. Now, it is important to note that if your credit score is below 630, many financial institutions will not approve your application for a credit product. Say, for example, a credit card or a loan or a line of credit. So it's really important to try to maintain a credit score above 630. So let's continue. So why is it important to have good credit? The first reason is lenders will give you a better interest rate on lending products. So if someone has a 780 credit score and they apply for a car loan, they will get a lower interest rate on the car loan. If someone has a 640 credit score and they apply for the car loan, they are going to get a higher interest rate on the car loan when they apply for it. So it's really important to maintain a good credit score at all times. The next reason, you may not get the credit product if your credit is bad. So if your credit score is very low, some financial institutions will not give you the credit product based on your low credit score. Now, that is not the only reason why you may not get the loan, but definitely having a good credit score helps tremendously. If you're going to fix your credit score, the first thing you need to do is pull your credit report. Okay. So how do you pull your credit report? So there are several ways to pull your credit report, but generally you could pull it through the credit reporting agencies. Okay, so the three main reporting agencies are Equifax, Experian, and TransUnion. Now they may charge you a small fee for a one-time pull of your credit report, and actually you could get one of these free per year with one of these three credit reporting agencies. You can also pull your credit report sometimes through your online banking. So whatever bank you have, they may have a free credit reporting tool which will allow you to see your credit report, and that's usually free to you as well. Just to make a note of this, there's also these monthly monitoring credit reporting services which you could get through Equifax, Experian, and TransUnion. This is also good as well if you want to keep a constant eye on your credit report. It's good to see if anybody tries to steal your identity, or just to see what's going on monthly on your credit score, how it's changing, and make sure everything is correct. Now, when I was getting all of this organized, I did find some information where you will get some free credit reports through Equifax website. So that's additional credit reports that you can get for free, and that's available. I will post the link for this in the comments section below at the end of the video. Okay, so next I'm going to explain how your credit score is calculated, because I think it's really important to know how your credit score is calculated. So I'm going to show you the 5 main areas they use to calculate your credit score. So the first one is payment history. Payment history makes up the biggest amount of your credit score. It makes up 35%. So this looks at if you have any late payments, so the number of late payments that you have and the type of late payments. It also categorizes it into a 30, 60, 90, or 120-day time period. So in other words, how late are you on those payments? 30 days, 60 days, 90 days, and so on. Okay, payment history also includes things like public records, collection items, bankruptcies, foreclosures, wage garnishments, and any delinquencies that were reported to collections agencies. So definitely you could see payment history encompasses quite a number of different items. The next area is used credit versus available credit. This is the second biggest, and this one is 30%. So what this means is how much of your total credit is being used in comparison to your total amount of credit available. So simply all this means is that if you have $30,000 credit limit for, let's say, a line of credit or a credit card, if you use, the full $30,000, you're maxed out, and you keep doing that for a number of months, it's going to start affecting your credit. Your credit score will start going down. Okay. Next area is type of credit used. So that's 15%. So this talks more about revolving credit versus installment credit. Okay, so if you have a lot of revolving credits, not so good. Okay, next area is new credit. So this means if you're doing recent requests for credit. Okay, if you do a lot of recent requests for credit, that affects your credit score. And that's 10 to 12%. And the last area is your length of credit history. Okay, so I'll explain all of these in detail, and I'm going to go through them one by one and how you could fix those different areas. Okay, but the length of credit history refers to how long you've had credit accounts for. Okay, so now that we have looked at how your score is calculated, we're going to look at the problem areas and how to fix it. Okay, so let's start with payment history since it's the largest one. So the first thing we'll look at is late payments. So late payments, they stay on your report for 7 years, a pretty long time. So I would just suggest avoid late payments as much as possible. Now, late payments, the way it works is once you go past 30 days and you don't make a payment, say on a credit card or any credit product, a loan or a line of credit, it's going to show up on your credit report. And this goes into like 60 days, 90 days, 120 days. The longer it is not paid off, the worse it is for your credit. And it also applies to if you have a lot of late payments. So if you have, 1 or 2 late payments, it's not so bad. But when you have 3, 4, 5, 6 late payments, then it's showing there's a pattern of bad payments, and that makes your credit score go down quickly. Okay, so I would just say avoid it altogether. Now, how would you fix something like this if it happened to you? The first thing I would suggest is just pay off any late bills that you have. I did have a client one time who apparently there was a mistake on his credit where he owed $35. It was an actual mistake. And he left it for I think a couple of months or a year or something like that. And it affected his credit really badly. And I just said to him, if it can't be resolved for $35, just pay it off. It's not worth ruining your credit over for $35. Now, once you do make those payments, try to write a letter and see if it can be removed. They don't have to remove it, but in some cases they might remove it for you. Okay. And always when you look at your credit report, make sure you see everything in detail. Look for any errors, because there is times that there could be wrong information going to your credit report. If you do see an error, call the lender or call your credit reporting agency as well. Let them know, and just let them know it's a mistake. It's not something you did, and ask them to fix it. They will fix it, as long as you let them know that it's something that you didn't do. Okay. So continuing on payment history, we're going to look at collections. Let's say you have something in collections. Collections do stay on your report for 7 years as well. Now, if you do have something in collections, they charge you interest over time. So, the longer it's not paid off, the more interest that's being charged. Okay, and that just makes it worse for you to pay off. And if anybody's had anything in collections, you know that it's not really good. They're going to call you, harass you, and it's just not a place you want to be in. Now, how would you fix this? Okay, if it is an error, you can, write them a letter and say to them, hey, this is a mistake, and they will look it up. Once they find the information, they will fix it, they will remove it, okay? And you do have the right to ask them to validate the debt. So it just basically means that you ask them to find out, if this is a legitimate claim or if it's a mistake. And they will fix it once they realize that it is a mistake. If you do have anything in collections, it's accurate, it's something you did, try to pay it off as quickly as possible. Now, the collections agencies, they will be willing to negotiate, most of them. So, if you have, let's say, something in collections for $15,000 and you offer them, let's say, $10,000 or less, they may be able to accept a lower amount. They don't necessarily have to accept the full amount of the debt that's owed. The reason why is because usually they buy the debt from, say, whatever company, and then they buy it at a much lower amount usually than what is owed. So in many cases, you can negotiate with them, and they are willing to negotiate. I just think the most important thing is to try to get it paid off so that it doesn't stay on your record and destroy your credit score. Okay, so let's look at the next area. So use credit versus available credit. This is 30%. So if you use a large amount of your available credit, it lowers your credit score. So what this means is, let's say, for example, you have a $15,000 credit card or a line of credit. So this is mainly in regards to revolving credit. So you have a $15,000 credit card or a $15,000 line of credit, and you use $14,500, so you're almost maxed to that limit. And let's say, for example, you don't pay this off for a couple of months, your credit score starts to go down. So it's really important to try to pay that off so that your credit score starts to go back up. So how do you fix it? Of course, pay off some of your used credit. So your lines of credit, bring the balance down basically. And also try to use less of your credit, because sometimes you start using a credit card or line of credit, and all of a sudden you realize you have a high limit and you're not able to pay it off quickly sometimes. So sometimes it goes on for months and months, probably even years for some people at a time. And that's just going to keep your credit score low. So the sooner you could pay these off, the better your credit score is going to be, and the faster your credit score is going to start going up. Now, one other option you can do, and I don't normally recommend this, but you could try to have more available revolving credit. So you could try and get an extra credit card or a line of credit. As I say, it's not what I would normally recommend people to do, especially if you have a problem using credit. But if you have some, let's say a credit card and it has a $5,000 limit or a $10,000 limit, and you don't use any of that, that will actually help your credit to start going back up. Okay? But I would say just, try to be more responsible of how you use your credit. Don't use it if you know you can't pay it off on time. And the only thing you do need to do is make minimum payments, but you also need to bring that balance down, because having that high balance on your limit is going to affect your credit as well. So just work on bringing the balance down, and then your credit score is going to start to improve dramatically. So I just wanted to take this time to say that if you find this video enjoyable and educational, please take a moment, hit the subscribe button, click the notification bell, and also add a like. I will be making a lot more videos in the next couple of weeks, and I also plan to make a video on a way to help you pay off your credit cards, your lines of credit, even your loans, without you having any cash available on hand. So it's going to be a really nice video, and I'm pretty sure you would learn a lot from this. So to help me continue with the channel, just hit the subscribe button, and you'll be getting lots of great videos in the future. The third area we need to look at is revolving credit versus fixed credit. So let me explain. Revolving credit is referring to things like credit cards, lines of credit, home equity lines of credit. So these are products where there is no end date in sight. You could keep paying this every month and it goes up or down based on how much you use. Fixed credit or installment credit has an end date in sight. So for example, if you have a loan, you could have a term of 1 year, 2 years, 3 years. And that has an end date in sight. So you know once you finish pay off the loan, within the time period, you don't have any more monthly payments. Whereas revolving credit, if you make only the minimum payments, it could take you a very long time just to pay off that revolving credit. So there's no end date in sight for the revolving credit unless you pay off the full balance. So too much revolving credit is not a good thing. If you have a lot of revolving credit, say for example 4, 5, 6 credit cards, 3 lines of credit, just by itself, meaning you have no installment credit, this is not good. Having no installment credit, examples things like mortgages, loans, that is not good as well. So how do you fix these? You want to avoid too many revolving credit products. So if your credit score or your credit report shows you have 5 credit cards, which are all revolving credit, and you have no installment credit or no fixed credit, like an example, a loan or a mortgage, that's going to start affecting your credit score. As you could see, this takes up 15% of your total credit score. So having some installment credit improves your credit. Okay, so one thing you can do, a couple different things you can do, is to get a small installment credit. So for example, you get a small loan, say for example, for like a computer or a car, having that combined with some revolving credit is going to start improving your credit. Because when you have just revolving credit, it doesn't look as good for you, and that's going to affect your credit score. Your credit score will go down over time. You need to show a bit of diversity in your credit. The other thing is be responsible. I know everybody has gone through the situation where you go into a supermarket or some other place and somebody tries to sell you a credit card. Just don't take every credit card that you see. I would say the maximum number of credit cards you probably should have is 3. You could have a credit card for points if you want to collect travel rewards. You could have a credit card for cash back at the end of the year, but you really don't need too many credit cards. So the next area is new credit. So this makes up 10 to 12% of your credit. Now, lots of recently opened credit also affects your credit score. So what this means is if you're applying for, let's say as an example, a car loan, and you go to, let's say, 2 or 3 or 4 different financial institutions to apply. If you do this over a period of time, so probably like a month, then these are all going to show up on your credit report. So having a whole bunch of applications within a short period of time is going to affect your credit score. Okay. Okay, the other important factor you have to look at is the length of time since you made inquiries. So if you, let's say for example, applied for a credit product, it's good to have a good amount of time in between every application that you make for a credit product. If the times between your applications are very short and you're doing quite a number of applications for credit products, this is going to affect your credit negatively. So you want to have, a couple of months, or I would even say years, in between each application you apply for credit. Because anytime you apply for any application, that's going to show up on your credit report as an inquiry. If you have too many of these within a short period of time, that's going to affect your credit negatively. So how do you fix these? So just try avoiding several credit checks for different credit in a short period of time. So if you just give it, I would say 6-7 months, even a year or more in between credit applications, that's even better for you. Okay, allow longer periods of time without applying for credit. And I would just say credit is not something you should really use to survive off of. You should really have cash and savings stored to do your transactions. Or if you're going to use credit, be able to pay off the balance in full as soon as you use it. Say, for example, if a line of credit or a credit card. So credit is just a product or a tool that you use, but you want to be in a position to be able to pay it off quickly. You don't want to keep balances for long periods of time on your credit. Next one is the length of credit history. So if someone pulls your credit and you don't have a credit product for a long period of time, let's say for example, you only have one credit card and you've only had it for 1 month, that's definitely going to affect your credit. Now, it's not going to affect your credit as much as some of the other areas, but it will affect your credit. So if you do have a credit card, try to keep it for a long period of time, over a number of years, I would say. Don't just get credit products like, say, credit cards or lines of credit and cancel them right away. I mean, you could pay off the balance and just keep the credit product. You won't be charged any interest once you pay off the balance in full. So as I said, keep a credit card for a long period of time. That's really going to help your credit score start to go up. If you have a mortgage or a loan, that's even better as well. That's going to show that you've been making payments on time every month and that you've had it for a long period of time. That's going to boost your credit score. I want to also mention something I talked about at the beginning, which is bankruptcies and foreclosures. Now, there's not too much you could do about removing bankruptcies or foreclosures, but it will come off of your credit over a number of years, so it will disappear eventually. The best thing you could do in that situation is just to work around it, work on the other areas of your credit. Once you work on the other areas of your credit score will start to improve. So if you focus on the other areas, your credit score will start to go up. The bankruptcies and foreclosures, it will stay on your credit as long as it is a legitimate bankruptcy or foreclosure, but it's not going to have a huge impact on your credit. You could still get a really good credit score even if it stays on your credit. That also is the same for like you had a past history of a collection item. Okay, so just work around the other areas and you'll be fine. So I've given you a complete guide on what to do to get a better credit score. I hope this helps. Just be aware that some of these things will take 1 to 2 months or more for your credit score to start increasing. You have to really just give it a couple of months. Your credit score will start to go up. So if you're new to this channel, subscribe, click the notification bell so you don't miss important videos. Give us a like and leave a comment. I will post the website address for the government website in the comments section below. I also will be responding to any questions you may have. Feel free to ask me any questions in the comments about this video. And if there are any topics you would like me to talk about, leave a message in the comment section and I will create a video on that subject. So that's all I have for you guys on this topic. So see you in the next video.